Now, we've covered why most traders get Bollinger Bands wrong and how to fix it in our first video on this series. And you can see that video. It's linked above or it's in the description below. And today we're going to dive into some advanced techniques and some pretty high-level tweaks that can impact your trading in a good way. Now, this one here, what very few retail traders know about, but it can totally change how you see the market. It's called the double Bollinger Band strategy. And here's the setup. You keep your standard Bollinger Bands on the chart, right? That's the one with the 20-period average and the 2 standard deviations. Then you add a second set of Bollinger Bands, but this time you set the standard deviation to 1. Now, this is going to create 3 clear zones, visual zones on your chart. And that's a pretty good map of what the market is doing. First, you have the uptrend zone, and that's the area between upper 1 and 2 standard deviation bands. And when the price is consistently trading in this channel, it's flashing a sign of a strong, healthy trend. And this is where you want to be long or looking for a chance to get long. The second is the downtrend zone, and this is the area between the lower 1 and 2 standard deviation band. When the price is grinding down inside this lower channel, it's signaling powerful downtrend. And this is where you should start looking for shorts or already be short. And third, and probably more important, is the chop zone or the no trade zone. Now, this is the area between the 2 inner bands, the +1 and the -1 standard deviations. When price is just bouncing around inside this central zone, it tells you that the market, the instrument, has zero clear direction. It's full of noise. It's a trap. And this trap is where you get chopped up. And this setup, it gives you a clear visual signal to just stay out. Protect your money until price moves back into one of the trending zones. Now look, no single indicator should ever be used on its own. And volatility bands like the Bollinger Bands, these are great. But they become more reliable when you can get confirmation from another tool. And here's a simple checklist to keep in mind. First is divergence. And this is probably the only time you should even think about trading reversal at the bands. And we covered this in the first video. So let's say price makes a new high and pokes upper band. But now here, you're going to look at your RSI or your MACD, and it's making a lower high. Now this is bearish divergence. So it's a clue that the momentum behind the trend, behind that big strong push up, could be running out of steam. Band touch combined with clear divergence is a pretty good reversal setup. And without it, just assume the trend's going to continue. Volume confirmation. And I'm saying it again as I did in the first video because it's that important. And it doesn't matter whether you're trading a squeeze breakout, a reversal, you need to have volume to back you up. You know, a reversal candle at the upper band on weak volume, probably just a quick pause. A breakout from a squeeze on really low volume, probably a fake out. So always look for volume confirmation for every entry. And again, we covered this earlier. Third, support and resistance. Your trading is going to get so much better when you just stop looking at indicators in a bubble. Start combining them with some classic price action. You know, a price that touches the upper Bollinger Band, that's interesting. But a price that touches the band and a major resistance level from a higher time frame, that's an A+ setup. Now maybe toss in some divergence with that too. It's an A++. So look for these areas where multiple signals line up and tell you the same thing. Now let's talk about settings. And let me ask you, are you still using the default 20 and 2 for every market, every time frame? And if you are, it's a big mistake. You know, even the guy who invented it, John Bollinger, now some people call it Bollinger. Now that's the guy who created the indicator. He said himself, these are not some magic numbers. They're just a starting point. Different stocks have different personalities. Different time frames have different rhythms. One size fits all approach is kind of lazy. So here's some practical advice. And it's one I say for every single indicator. Start with the defaults and adjust. So if you're looking at a faster moving market or you're scalping on a 5-minute or a 15-minute chart, the 20-period band, probably too slow. Look at a 10 or a 14 band to get the signals to be a bit more responsive. But if you're trading something really volatile like crypto or some meme stock, the standard 2 deviations may be too tight. Can cause you to get chopped up. In that case, try widening it to 2.5 or even 3, and this will take out some of the noise. If you're looking for trend following on a daily or weekly chart, a longer setting like a 50-period moving average can smooth things out. And Jay, who runs our Iron Condor program over here at NetPicks, that's exactly what he uses. And it gives you a much clearer picture. So the key takeaway, you need to test and you need to adapt your settings to fit the unique personality of whatever you are trading. So let's put it all together. If If you want to stop getting trapped, you got to throw out this old simplified rules and the way the textbooks are telling you to trade. First, stop blindly selling at the upper band and buying at the lower band, especially in a strong trend. Second, master the squeeze. Look for volatility to dry up, trade the breakout with volume confirmation, or use it as information only. Look for that big move and then take a pullback to get in on the direction. Third, recognize when price is walking the band and see for what it is. It's a sign of incredible trend strength. 4, try the double Bollinger Band setup to create a clear trend zone and chop zone on your chart. Always demand confirmation. Look for divergence. Make sure your trades line up with some support or resistance levels. And finally, do not be afraid to change your settings. Fit the indicator to the market, not the other way around. And when you make these adjustments, you start trading what the market is actually doing, not some old textbook rule that says you should do it this way. So if you got some value out of this Bollinger Band breakdown, make sure to subscribe. Don't want you to miss any new videos. Let me know in the comments which one of these techniques you're going to try out.
Everything discussed here is our opinion, and it is not to be taken as investment advice because we are not your financial advisor, nor have we considered your personal situation as your fiduciary. This presentation is for your education and entertainment only. Please review NetPick's full risk disclaimer and privacy policy.